Okay, students, let's start the class and we are starting from now cost of capital. In the previous live revision class, we completed all the topics of investment appraisal. So we have covered investment appraisal in the live revision classes. Now the next topic is cost of capital. That is weighted average cost of capital. When we say cost of capital, first of all, everyone should know the meaning of cost of capital. Actually, cost of capital represents cost of financing. Cost of capital represents cost of financing. Second, the objective of cost of capital is investment appraisal. Objective of cost of capital is investment appraisal. So basically, cost of capital represents cost of financing, and objective of cost of capital is investment appraisal. Next point, when we say cost of capital, we know the meaning of cost of capital. The cost of capital means simply cost of financing. So before even calculating weighted average cost of capital, we need to know how to calculate the cost of individual source of finance. For example, if an organization raises the finance in the form of equity to make investment in a project, then that particular organization will have to bear the cost, and the cost of equity is K. If a company raises the finance in the form of debt, then the cost will be KD1 minus T. Now the question is, why do we write cost of debt after tax? Because fixed interest payment results in tax saving. Fixed interest payment results in tax saving. That is why KD1 minus T. Obviously, when it comes to ordinary shareholders, we provide them dividend, and dividend is itself after tax. That is why we never write KE1 minus T. It is always KE. But when it comes to loan, obviously on loan, we pay interest. Dividend never results in tax savings, obviously. Interest payment results in tax saving. So the cost of debt is KD1 minus T. Third and the last, if an entity raises the finance in the form of preference shares, then you have to bear the cost, and the cost is KP. So there are three sources of finance. That is equity, the cost is KE. Second is the debt, cost is KD1 minus T, and the last one is preference shares, and the cost is KP. When it comes to KE, cost of equity, we can calculate this K by using two models. One is dividend valuation model, also called dividend growth model. The second one is capital asset pricing model, CAPM model. So there are two models in your financial management syllabus to calculate KE. When it comes, if I talk about AFM, in AFM, actually, we have three models. In fact, in the third model, recently they have ACC had made little changes as well, and those changes are really nice. But right now, financial management, there are two models to calculate KE. CAPM, capital asset pricing model. The formula is very simple. K is equal to RF plus RM minus RF and equity beta. K, of course, cost of equity. K is cost of equity. Now, you need to know one thing. That is same thing which is cost for one party, it's going to be written for another party. Means if I talk about shareholder, the same thing becomes a minimum return required by the shareholders. So K is actually a minimum return required by the shareholders. So K, cost of equity. Another interpretation is minimum return required by the equity holders, RF. Risk-free rate of return. Risk-free rate of return. And a very simple interpretation of risk-free rate of return means when an entity makes investment in government bonds, treasury bills. In financial management, the benchmark of risk-free investment is the investment in government bonds. The logic behind that is normally governments, they don't collapse normally. So simply if an entity has made an investment in government bonds, so that is treated as a risk-free investment. RF is risk-free rate of return. RM, average return on a stock exchange. Average return on stock exchange, always given to you. Difference between RM minus RF is equity, risk, premium. Why equity? Because if you buy shares of XYZ company, you will become an equity holder. Why risk? Obviously, after making an investment, you will face the risk as well. Premium means over and above something. Obviously, if I'm taking a risk by making investment in equity shares of XYZ company, so I'll be demanding a return higher than RF. So the name is equity risk premium. It has another name as well, market risk premium. Market risk premium. Before developing any understanding of equity beta, you should need to know the beta. When we say beta, beta is a measure of risk. Beta is a measure of risk. Then if we say risk, there are two types of risk. One is systematic risk, and then there is unsystematic risk. Unsystematic risk is a diversifiable risk. Basically, unsystematic risk is a diversifiable risk. Your company can diversify this risk, means your company can reduce this risk. Your company can spread this risk. Even your company can eliminate this risk. Simple example. If you put all of your money in one company's shares, so we'll say you don't have a diversified portfolio of investment. So instead of putting all the money in one company's shares, if you put your money in, assuming 10 or maybe 20 different companies, let's say if you have $1 million, if you make equal portion of 20 equal portion of $1 million, that will be somewhere $50,000, 5% of your total investment. So if an entity invests in 20 different companies, and in each company you invest 5% of your total investment, means your company is having $1 million divided by 20, I'm getting $50,000, which is 5% of the total investment. So if we make investment in 20 different companies, it means we can say that we have a well-diversified portfolio of investment, because if share price of one company reduces, still there's a 95% chance that you may get the benefit. Even the share price of two companies reduces, still there's a 90% chance you will be getting a benefit. It means now you have a well-diversified portfolio of investment. Now, a very important point is, like you might have heard at your very early studies, that do not put all the eggs in one basket. It's the same concept here. According to CAPM, so capital asset pricing model is having number of assumptions, but one of them is that investor is having a well-diversified portfolio of investment. Since the investor is having a well-diversified portfolio of investment, that is why CAPM assumes that unsystematic risk is zero. So we have to work according to this assumption. Either it is 0 or not, because CAPM assumes that investor is having a well-diversified portfolio of investment. That is why unsystematic risk is 0. We are left with systematic risk, not a diversifiable risk. You cannot diversify. Not a diversifiable risk. For example, if your government increases the tax rate, so you have no option. You have to pay more tax. If interest rate increases in your country, so you have no option. You cannot bring down the interest rate, not possible. High interest rate means it becomes expensive to take loan. It becomes expensive to take loan and make investment. Automatically, you will not be making more investments. But obviously, if the government increases the interest rate, you cannot bring it down. So it's a systematic risk. If inflation rate goes really high, you cannot do anything. Systematic risk. So systematic risk is not a diversifiable risk. Now listen carefully. It means if this is your equity beta, we have already discussed that CAPM assumes that unsystematic risk is 0. It means logically we are left with systematic risk. Now, definitely equity beta is a measure of systematic risk. Equity beta is a measure of systematic risk, because in capital asset pricing model, we do not have unsystematic risk because we assume that investor is having a well-diversified portfolio of investment. That is why unsystematic risk is 0. We are left with systematic risk. So basically, equity beta is a measure of systematic risk. Is a measure of systematic risk which indicates that how your investment will respond to the changes in a stock index. For example, if the index, I'm just giving you the example, if an index increases by 5% and your investment increases by 10%. So you are generating return more than the market. So we can say one thing, your investment is a high risky investment, because if this index reduces by 5%, then your investment will reduce by 10%. Always remember one point, when someone is generating more than the market, and if something goes wrong in that market, so that entity will face the loss more than the market. So you just need to know one thing, equity beta is a measure of systematic risk, which indicates that how your investment will respond to the changes in a stock index. Another interpretation of equity beta is, you can say it's a residual risk, a remaining risk which you have to face. How? Basically, when we say risk, there are two types of risk. One is systematic and another is unsystematic. In CAPM, unsystematic risk is 0. So we are left with only systematic risk. So you can say that equity beta measures the remaining risk, residual risk. Okay, now, whatever the KE comes, logically that KE depends on your equity beta. For example, let's say we have RF 7%, RM 15, equity beta is 0, 0.75, 1 and 1.75. And we have to calculate K. And obviously there will be 4 different Ks due to having different equity beta. Let's try. Number 1. K is equal to RF plus RM minus RF. Equity beta is 0. So K will be equal to 7%. So number 1 finding is, when your equity beta is 0, equity beta 0 means logically you have made a risk-free investment. If you have made a risk-free investment, then your KE will be equal to RF. So whenever equity beta is 0, KE will be equal to RF. Second, K is equal to 7 plus 15 minus 7, and equity beta is 0.75. So K is equal to, just a minute, 8 and this. I'm getting 13%. So the finding is, if equity beta is less than 1, equity beta less than 1 means your investment is less riskier than the market. When my investment is less riskier than the market, I'll demand a return less than the market. So whenever equity beta is less than 1, you will find KE less than RM. Third, K is equal to RF RM minus RF. Equity beta is 1, so K is equal to 15%. So when beta equity is 1, it's a benchmark beta. Beta equity is equal to 1 is a benchmark beta, which indicates that your investment systematic risk is equal to the stock index systematic risk. It means that if my investment faces the same risk which is in the market, so KE will be equal to RF. Fourth, K is equal to 7 plus 15 minus 7 into 1.75. It means I'm getting 21%. Whenever equity beta is more than 1, it means your investment is more riskier than the market. When my investment is more riskier than the market, then I'll demand the return more than the market. Now, a very important point is KE. From capital asset pricing model, it actually relates to the equity beta. So simply K from CAPM relates to the systematic risk of investment. Systematic risk of investment, which we have seen. KE changes according when beta equity changes. Formula is here. Formula. K is equal to RF plus RM minus RF and equity beta. So K is equal to RF plus RM minus RF and then equity beta. Now, the second model to calculate K is dividend valuation model. You can also say dividend growth model. There's no issue at all. Dividend valuation model, K is equal to D naught 1 plus G upon P naught plus G. This can be rearranged like this as well. K is equal to D1 upon P naught plus G. This can also be, okay, where let's say G is 0, then K will be equal to D naught upon P naught. K. We know that K is the cost of equity. Cost of equity. Another interpretation is minimum return required by equity holders. Minimum return required by the equity holders. Required by the equity holders. K is the cost of equity and the second is minimum return required by the equity holders. D naught D naught is current dividend per share. D naught is current dividend per share. G is the annual dividend growth rate. Annual dividend growth rate. And in dividend valuation model, we assume that dividend growth model is that in DVM, we assume that growth rate is constant. In dividend valuation model, we assume that annual dividend growth rate is constant. Now, very important point, D naught 1 plus G is equal to D1. And this D1 is next year. Expected dividend. This is next year expected dividend. Which means that if this is D24, then 1 plus G will give us D25. Another important point is, look at this formula. Whenever we are using this formula, make sure, do not make one mistake, that is, your KE will always be higher than the growth rate. So mathematically, do not make a mistake when you are using dividend valuation model to calculate KE. So logically, your KE is going to be more than annual dividend growth rate. Now P naught. P naught is the current share price. Current share price X div. X div means excluding dividend, which does not have the impact of dividend. If examiner gives you the cum price, cum div means cumulative of dividend, including dividend, we will not be using this. Nothing is mentioned. We always assume given share price is the X dividend. For cum dividend, examiner will write the word cum dividend. We will not use cum dividend price. Why? Because cum dividend price exists just for few days. So we are not going to take that. Always take the X div price. Now, this dividend valuation model, if examiner gives you the information like this, assuming dividend per share is 0.20 in 2020. Dividend per share is 0.24 in 2021. Then we have 26 in 2022. Then let's see, we have 27 in 2023, 28 in 2024. And let's say the current share price is 12.28 cum div. And the requirement is calculate KE. Obviously, first we have to calculate the annual dividend growth rate, and after that we can calculate KE. Now, listen. How many years dividend is given to us? 1, 2, 3, 4, and 5. So first you have to calculate the growth rate. Annual dividend growth rate is equal to last dividend per share divided by the first dividend, which is 0.20. Examiner has given us the information of the 5 years. So it means growth will come in the 4. Out of 5, the growth comes in the 4 years. Why? Because in the first year, the first dividend is there, growth comes from the second year. So if examiner gives you the data of 10 years, then you have to take power 1/9 minus 1. Okay, now how we are going to utilize this formula in Excel, I'll show you that also. But mathematically, you should know this. 1/4 means logically 0.25. 1/4 means 0.25. So logically the power is 0.25. This will help us especially in solving the question in Excel. So 0.28 divided by 0.20. Then whatever comes, take the power 0.25. I'm getting 1.0877 minus 1. Then whatever the result comes, multiply by 100. I'm getting 8.77 with a rounding of 6%. So annual dividend growth rate is logically 8.776%. Let's calculate K. Current dividend is 0.28, growth rate into 1.08776. Share price examiner has given us 12.28, but cum div, so it means X div is 12. You have to deduct the dividend. Plus 0.08776. Let's use the calculator. So 0.28 multiplied by 1.08776. Whatever comes divided by 12 and plus 0.08776. I'm getting K 11.3%. Just a minute. Let us see each and everything on Excel. How to perform all this on Excel. Let me share the Excel sheet. Share this. Okay, I hope that everyone can see this Excel sheet. Okay, I just want to show you how to calculate annual dividend growth rate is equal to bracket. Last dividend was 0.28 if I'm not wrong. First is 0.20. Bracket close. Shift and 6 for the power. As I have already cleared one thing that 1/4 means the power is 0.25. Then minus 1. So we're getting 0.8775 if you convert that into a percentage. So obviously 9%, or you can do this. So I hope everyone knows that now how to how to calculate this annual dividend growth rate on the spreadsheet. Now let's just check the KE. KE is equal to, it was D naught 0.28 multiply by, it's going to be 1.0878 divided by, can I say 12? Then whatever comes, we have to add 0.0878. So let me use the bracket. Or even we are not using the bracket. Let's see what happens. 0.8, 0.0878. So we're getting 11.3 something. If you convert this in a percentage, it is 11%. I hope it is clear to everyone how to get this G on the spreadsheet, how to calculate this K on the spreadsheet. Let's go back to the OneNote. Okay. There is one more formula I would say, that is Gordon growth model. G is equal to B RE. So G, we know that annual dividend growth rate. B is the retention ratio. B is the retention ratio. Now, what do you mean by retention ratio? For example, if company says we are paying 40% dividend. Obviously, when you are paying 40% dividend, it means you are retaining 60%. If company pays 30% dividend, it means you are retaining 70%. So very easily we can calculate a retention ratio like B is equal to 1 minus payout ratio. Logically, if we know the payout ratio, you can calculate a retention ratio, payout ratio, payout ratio. Organizations, obviously, they pay in the form of dividend from their earnings. So D naught upon earning per share will give you payout ratio. Okay. If you ask EPS, so obviously in financial management, calculation of EPS is very simple. We don't go for a proper falling IAS 33, not required at all. Simply profit after tax divided by total ordinary shares. No need to go towards IAS 33, where we make 5 columns to get weighted average ordinary shares. So in FM, EPS is simply equal to profit after tax divided by total ordinary shares. Okay, now RE is simply a return on equity. Return on equity. Sometimes your examiner uses the word even return on investment is equal to simply profit after tax divided by total equity. Obviously, it depends on the data. Which formula do I need to use to calculate annual dividend growth rate? But you should know this Gordon growth model of calculating annual dividend growth rate. And you need to know one more thing. What is that? If company distributes entire earnings, obviously, if you're distributing entire earnings, and companies, they distribute their earnings in the form of dividend. If company distributes entire earnings, if this is the case, then retention will be 0. When the retention is 0, then growth rate will be 0. Obviously, entities, they retain to reinvest, and that reinvestment brings growth, not in the business. It brings growth in your dividend paying ability, capacity also. When you are distributing each and everything, you are not retaining anything, you're not reinvesting anything. So from where the growth will come? It means it will remain same whatever you are doing right now. So very logical. But the question is, if company distributes entire earnings, then there's no retention, then there's no growth rate. Now, if a company raises the finance in the form of debt, so we have already discussed the cost which company will have to bear, it is KD 1 minus T. This is cost of debt after tax, because fixed payment of interest results in tax saving. Fine. But when it comes to debt, so there are different types of debts, and each debt is having a different, I would say, formula to calculate KD1 minus T. Number one, let's say bank loan. The easiest is the bank loan. If an entity has taken bank loan to make investment, and assuming bank loan is 10%. If we have 10% bank loan, let's say the tax rate is 20%. So simple to calculate KD1 minus T, that is 10%, 1 minus tax will give us 8%. Which formula? Which formula, please? There's no need to write a formula. There's no need to write a formula. You will be using it. I think, have you seen right now when we solve DVM on Excel? Yes or no, please? So what were we doing? We were using the formula. Am I right? So without using the formula, how can you get the answer? without using the formula. Yeah, no. So that is applying means using the formula. Please, dividend valuation CAPM will be given to you in exam. But if I think if you are appearing in FM, normally everybody knows these formulae, CAPM and DVM. Otherwise, CAPM will be given to you in exam. Don't worry at all. So bank loan. So if bank loan is given, then simply how will you calculate KD1 minus T? 10% 1 minus T. Second, a redeemable debt. How to calculate KD1 minus T of irredeemable debt, irredeemable bond? Very simple. KD1 minus T is equal to I 1 minus T divided by P naught into 100. P naught, that is current bond price. X interest. P naught is the current bond price, but X interest. Okay. T is the tax rate, I cash interest. For example, this 10% irredeemable bonds. Par value is $100. Tax rate 30%. Market value of bond. Market value of bond is, let's say, 115. Come interest. Nothing is mentioned, then we always assume X interest. For come interest, examiner will have to use the word come interest. Required is KD1 minus T. So simply use the formula of irredeemable bond. KD1 minus T is equal to 10% of 100 is 10. 1 minus tax rate. So we will 115 minus the interest 105. Let's see. I'm getting 6.667%. Part B, if tax rate becomes 20%, impact on KD1 minus T. From 30, if the tax rate becomes 20, they're not asking to calculate KD1 minus T, they're asking impact. Okay. KD1 minus T is equal to 10. 1 minus tax rate divided by 105. So logically your KD1 minus T will increase. Now I'm getting this 7 point with a rounding of 62%. Again, 7.62% is not the answer. They have asked the impact. So impact is KD1 minus T increases by 7.62% minus 6.667%. So 7.62 minus 6.667. 0.667 953%. So the impact is your KD1 minus T will increase by this. So always remember one point. Tax rate reduces, KD1 minus T will increase. Now, if your company raises the finance in the form of redeemable bond, which is very important, redeemable bonds can be non-convertible bonds, can be convertible bonds. There are two possibilities. One is straight debt. Straight debt means without conversion option. Without conversion option. And then the second is convertible bonds. Convertible debt means with conversion option, of course. With conversion option. Number one, whenever redeemable bond is given, either a straight debt or a convertible debt, we calculate KD 1 minus T by using IRR. So there are three possibilities. One, the bank loan, second, irredeemable bond, and the third is redeemable bonds. And in redeemable, actually, we have two possible options. Straight debt means without conversion option, convertible bond means with conversion option. Whenever redeemable bonds are given, you have to calculate KD1 minus T by using IRR. But everybody, I hope, knows that now in FM exam, the shortcut of IRR is available. And obviously, all those shortcuts which are available in exam, you are supposed to use them. Like the shortcut of NPV is available, so you have to use it. Shortcut of IRR is available, so we have to use it. But obviously, before utilizing the shortcut of IRR to get this KD1 minus T, first we need to know what are the inputs that we have to give to a without input. Obviously, you can. What is the point of using IRR formula or IRR shortcut? So, what are the inputs? Let us first discuss that. Assuming the debt is having a maturity period of, I'm just assuming, debt is having a maturity period of 4 years. T0, T1, T2, T3, and T4. I'm just assuming debt is having a maturity period of 4 years. Okay. First of all, you have to just write cash flows. Time 0, always take the market value of bond. We will always take the market value of existing bond, outflow, then just take inflow of interest. Interest plus in the last year, there will be a redemption amount also. In the last year, there will be a redemption amount also. And very important point is, when we say redemption amount, so this is RTQ, means read the question carefully. Because for redemption amount, there are a number of possibilities. Number one, nothing is mentioned, then redemption will be at par value. Nothing is mentioned, redemption will be at par value. Second, redemption could be at premium. Obviously, if the redemption is going to be at premium, it will be mentioned in the question. Third and last, listen carefully. Number one, if examiner has given you the convertible bond, obviously, if examiner has given us the convertible bond, then investor is having two options at maturity. Either to convert the bond into shares or to get the redemption amount. Logically, investor will go for a option which gives him a higher price. If conversion value is having a higher value than the redemption amount, so investor will go for the conversion. If redemption amount is higher than the conversion value, then investor will go for redemption. It means, let me repeat, if given bonds are convertible bonds, number one, and number two, if conversion value is higher than the redemption value, if conversion value is higher than the redemption value, then conversion value comes. So after writing all the inputs of, I would say, cash flows, the time zero market value of existing bonds, interest, by using IRR, logically, whatever you get, it's going to be KD. Whatever you get, it will not be KD 1 minus T, because I'm not putting interest 1 minus T, which you can do that. I'm just putting interest. So whatever you get, it will be KD. After that, what do you need to do? Assuming the KD you have calculated, it is 8%. So it's very simple. 8% 1 minus tax rate will give you, assuming 5.6, if I'm not wrong. So by using, then after putting all the inputs, you have to just use a shortcut of IRR. Let me share the Excel sheet once again. And let's utilize this shortcut of, I would say, IRR. I hope that everyone can see this Excel file. Yes. Time 0, 1, 2, 3, and 4. I'm assuming the data, okay? Please. Cash flows. I'm assuming the market value of existing debt is 112. Interest rate is, let's say, 7%. So if I take 7% of 100, obviously it will be 7. Option of the drag. And in the last year, we have to take the redemption amount. Nothing is mentioned, redemption will always be at par value. So we have taken all the cash flows. Now, actually, we need KD 1 minus T, but first I'll be getting a KD by using the shortcut of IRR. Just select this and select all the values. KD is 4%, but we need KD 1 minus T. So here comes the KD 1 minus T. Let's say the tax rate is 30%. If tax rate is 30%, you just need to multiply this with 0.7. So just a minute. So we are getting around 2.6%. It means exactly it is not a 4%. If you just check, it is somewhere 3.7%. That is why it is 2.6% is coming. Otherwise, we know that if you take 70% of 4, it will be 2.8. So first simply calculate the KD and after that 1 minus T. And let me repeat, you have to use all the shortcuts which are available to you in exams. Because the checker, the marker expects that you will be using the shortcuts. Another point is you are not supposed to directly write the KD 1 minus T by using your calculator, not allowed. You have to use this shortcut. Let's go back to the OneNote. Okay, third, preference shares. If the company raises the finance in the form of preference shares, then the cost is KP. D naught upon T naught and obviously 100. KP is the cost of preference shares or minimum return required by preference shareholders. D naught, preference dividend per share. Preference dividend per share. P naught is current preference share price. Obviously, X div. For example, we have 6% preference share capital. Assuming it is just an assumption, 10 million. Par value is $1. Current preference share price is 0.8. Nothing is mentioned, then the given price is X div. Let's calculate KP. Par value multiplied by the percentage will give you D naught, 0.06 divided by P naught into 100. So 0.06 divided by 0.8. I'm getting 7.5%. Okay. Now for calculating weighted average cost of capital, we have to know the market value of equity. How do we calculate market value of equity? You have to take share capital. Share capital divided by par value will give us issued shares into P naught. P naught is the current share price. Obviously, X div. So the market value equity, how do we calculate share capital divided by par value? Actually gives us issued shares into P naught, and P naught is the current share price X div. VD, market value of debt. How do we calculate? Nominal amount of debt. Nominal amount of debt which you will get from statement of financial position divided by par value. Normally the par value of bond is 100. Multiply by P naught, and this time P naught will be the current bond price. Current bond price X interest. Nothing is mentioned. We know that given price is X interest. Market value of preference shares VP. Just take preference share capital, preference share capital divided by the par value into P naught. P naught will be current share price X div. Current, obviously preference share price X div. So formula of the WACC is weighted average cost of capital is equal to K. Market value of equity. You can do this. KE into V. KD 1 minus T into VD. KP into VP. So whatever comes, everything is divided by basically VE plus VD plus VP. So KE multiplied by V plus KD 1 minus T multiplied by VD plus KP multiplied by VP. And entire answer will be divided by the sum of market value of equity plus market value of debt plus market value of preference shares. So students, in today's class, we have discussed how to, obviously it's a live revision class, so we have to be a bit quick. KE, KD1-T and KP. In the next class, we'll be discussing few questions on cost of capital. And then after the completion of cost of capital, I'll announce the next topic. Then we'll move on the next topic. KP formula is here. KP is equal to D naught upon P naught into 100. D naught is the current preference dividend per share. P naught is the current preference share price, which is X div, excluding dividend. Okay. So students, I try my best to discuss more or less all the concepts of WACC, but still few concepts are left, like theories on capital structure, traditional theory, with tax world, without tax world. We need to discuss that as well. And we'll be discussing few questions also on this cost of capital revision. And after the revision of cost of capital, I'll be discussing the sources of finance with you. So the coming topic is again the cost of capital, plus if we get the time, which I hope inshallah will get the time, then I'll be discussing sources of finance as well. But we have, before this, students, we have already covered the entire revision of investment appraisal. You can check that. This is our second topic in the revision. I made a commitment that you will get the entire financial management revision through live classes. But it does not mean that you're not watching the pre-recorded entire course. So pre-recorded entire course is extremely important. The live revision classes, they're revision classes. So please, I would just request, please try to complete your pre-recorded lectures as soon as possible so that you can get more time for the practice. And these live revision classes, they also serve the purpose of a smart revision, because in a very short period of time, you will be able to, revise the entire FM. Actually, there's no need to buy any book, number one. You can just ask my admin. They will share my notes with you. Though my financial management notes of ASA, they are more than enough to read to cover the theoretical parts. There's no need to go for a book reading, number one, because right now you don't have so much time. Exams are very near. So just focus on the notes admin is going to share with you if you don't have. But please try to complete the lectures as soon as possible. So thank you very much. See you all inshallah in the next class, and I'm expecting to have a next class tomorrow. Timings, if we have a class tomorrow, timings in the evening, admin is going to share with you. Thanks a lot.